One number, 40. That is how many times greater the median net worth of the American homeowner is compared to the American renter. 40 times, not 40%, 40 times. And that gap exists at every income level, in every market through the economic cycle. So here's the question we're going to spend the next 15 minutes answering. If we're entering one of the most unstable economic environments in modern history, does that gap finally get smaller? Or are millions of Americans about to find out waiting was the most expensive decision they ever made?
That's right, because right now, most people think the safe move is patience. Wait for rates, wait for stability, and wait for elections, and wait for the inflation to cool. Wait for the markets to calm down. But history shows something fascinating. The families that usually build most wealth during uncertain times are not the families who hide from instability. They are the families who own assets while instability is still happening. And that matters right now because America is dealing with simultaneous pressure points we have not seen together in decades. Tariffs, global conflict, sticky inflation, a housing shortage estimated roughly between 3 to 5 million homes nationally, and now a global digital currency race that could reshape the purchasing power of money itself over the next decade.
By the end of this episode, we're going to answer one question. In a world becoming more expensive, more volatile, and more uncertain, what actually becomes safer, waiting or ownership? Stay with us and you'll find out. So let's name what is actually happening right now. Not the headlines, the structure underneath the headlines. Because whether people realize it or not, the economic foundation underneath America is shifting. The United States is now operating under a tariff environment that is actively reshaping global supply chains. Steel, lumber, electrical components, appliances, and concrete inputs. Many of the materials connected to construction and the development that we've seen elevated costs because of the trade tensions and supply disruptions. And here is the problem nobody's talking about. America was already short millions of homes before this all started. Depending on the estimate, the housing shortage sits somewhere between 3.5 and 5 million units nationally. I'm going to say that again. 3.5 or 5 million units nationally. That's how many homes we're short. All right, now layer in higher construction costs on top of that shortage. That does not magically make homes cheaper. It makes new supply harder to create. And when the supply tightens while population and demand continues moving forward, existing real estate becomes more valuable through scarcity alone.
Yeah, and then there's the geopolitical environment, right? Europe, the Middle East, Asia, global shipping lanes, and energy volatility. The commodity pricing, investor uncertainty, we are watching multiple pressure points hit the global economy simultaneously. And historically, during periods of instability, hard assets tend to outperform the soft confidence. So because your home does not trade minute by minute like a stock does, your equity does not vanish because a headline appears overseas. And while markets can continue to panic over the short term, people still need a place to live every single day. Shelter demand survives recessions, period, end of story. Shelter demand survives inflations, and shelter demand survives political cycles. That is why real estate has historically remained one of the foundational long-term wealth vehicles for the American middle class.
And then there's the piece that almost nobody is discussing publicly yet, the currency war. China continues developing infrastructure around the digital yuan in an attempt to reduce dependence on the US dollar and the Swiss system over time. Now, whether people agree with that strategy or not is irrelevant. The point is this. The world is beginning to question how global trade and currency dominance may look over the next 20 years. And whenever purchasing power becomes uncertain, people historically move towards real asset, land, infrastructure, property, things with intrinsic utility. Because your home is not just a line item on paper. It is shelter, it is location, it's scarcity, and it's tangible. And in unstable environments, tangible matters.
Yeah, which is why the irony of this market is pretty fascinating. Most Americans, they're looking at uncertainty and deciding whether to wait or not. But uncertainty itself may be the very reason ownership becomes more important, not less.
Off the rim!
Oh, almost. Boy, that was close.
Hey, what's up for today, Nettie?
All right, now let's talk about what uncertainty does psychologically, because most people are getting this equation completely backwards. When risk rises, human beings freeze. We delay, we pause, we wait for clarity. And emotionally, that instinct makes perfect sense. But financially, that instinct can become very devastating because renting, it's not neutral. Renting is not standing still. Renting is negativity compounding. The average American renter now spends roughly 30% of their income on housing. In many major metropolitan markets, it's closer to 40%. So let's make this real. A family renting at $2,500 per month will spend $150,000 over 5 years. And after those 5 years, no equity, no ownership, no appreciation, no asset, no leverage, nothing, nada.
That's right. And meanwhile, the owner next door may have spent those same 5 years building wealth from 4 different directions simultaneously. Paid down principal, appreciation, tax advantage, and a future rental positioning. That's the part people miss because most people think homeownership is just a monthly payment comparison. It's not. It's a wealth building system. And history has shown the system repeatedly rewards people who enter before conditions feel perfect. The greatest generation bought during the Depression and World War II. Baby boomers bought during double-digit rate and oil shocks. Gen X, they bought during the savings and loan collapse and the dot-com era crash. Every generation had a reason to wait. Every generation that waited usually ended up with a massive regret story.
And every generation that owned assets during uncertainty usually widened the wealth gap. That is the pattern. Not because they timed the market perfectly, but because they participated while assets continued compounding underneath them. So, I want to shift the entire framework of this conversation. A home is not just a lifestyle upgrade anymore. In environments like this, ownership becomes infrastructure, a foundation, protection against rising shelter costs, protection against inflation, protection against future scarcity. And the dangerous part? Most people will not realize what happened until years later because wealth gaps do not explode overnight. They widen quietly, one rent payment at a time.
Yeah, Manley, and the numbers behind this, they're pretty staggering. According to the Federal Reserve Consumer Financial Data, the median net worth of homeowner is approximately 40 times greater than renters. 40 times. And that is before accounting for what may happen if inflation remains structurally elevated over the next decade. Because inflation does not just raise prices, it rewards ownership. The owner benefits from asset inflation. The renter, they just absorb price inflation. That difference changes lives forever.
Spock, remind me to tell you that I'm sick and tired of your logic.
That is a most illogical attitude.
So let's stop talking emotionally and start talking mathematically, because I don't want anyone leaving this episode with fear. I want them leaving with the framework of the 4 pillars of homeownership economics. This is how the American middle class has quietly built wealth for generations. Pillar 1, pay down equity. Every mortgage payment reduces the principal. That reduction moves directly into your net worth every single month, automatically. Meanwhile, 100% of a rent payment leaves your household forever. One system compounds towards ownership, the other system compounds towards dependence.
That's right. Now let's talk about pillar 2, appreciation. Now, yes, real estate moves in cycles, markets matter, but timing matters as well. But long-term appreciation has historically remained one of the greatest wealth engines available to the middle-class Americans. So let's make this real. A family buys a $400,000 home with 5% down, $20,000 invested. If that property appreciates just 4% annual over the next 5 years, that home now becomes worth roughly $486,000. That's approximately $86,000 in pure appreciation. On a $20,000 down payment, that is leverage working for the middle class instead of against them.
All right, Pillar 3, tax strategy. The U.S. tax code has historically rewarded homeownership. Mortgage interest deductions, property tax deductions, primary residence capital gains exclusions, potential depreciation strategies later through investment property conversion. Again, talk with a qualified CPA for your specific situation. But the framework, it's undeniable. Ownership unlocks financial tools renters never have access to.
And finally, let's talk about Pillar 4, which in my opinion is the most important because it really shows who is operating out of fear and who is operating out of facts. Future cash flow is what we're seeing with Pillar 4. This is the pillar almost nobody thinks about during their first purchase, but this is where generational wealth pattern begins. You buy today, build equity over the next 5 to 10 years, and then life changes. So instead of selling, that first property then gets converted into a rental. Now, somebody else begins helping you pay down your mortgage. Meanwhile, the property may continue appreciating. And now, instead of having a place to live, you have created an income-producing asset. That is how ordinary Americans are slowly becoming financially resilient over time. Not through gambling and not through perfect timing, but through deliberate ownership. And right now, more than ever, people can flip the script because right now they're on fear mode and they're thinking, what do I do to try to help myself? Not understanding that they're missing one of the biggest opportunities of a lifetime where they can flip the script and turn that fear into factual understanding, knowing that when you become an owner, now you have leverage. Now you have debt positions that are not just going to help you now, but they're going to help you long term. So it's kind of like a full circle moment here, Manley, where when people are afraid to be homeowners, not understanding that as soon as they become a homeowner, that fear goes away and gets pushed to the rest of society that are going to continue to fear. And what are they? They're going to be renters. And unfortunately, most of them are going to be renting forever.
Yeah, perfectly said, Anthony. And the flip the script is really the biggest part of this angle that I want to just nail down, because we're trying to tell you to stop being a renter. We want you to be an owner and then want you to be a landlord. So this might sound crass, but so you could take advantage of the people that are going to be renters forever. The financial impact of your world is massive, and that's what people need to understand.
Yeah, I mean, it's what we talked about a couple episodes ago on the K-curve economy, especially in this environment. You're going to have asset havers and asset chasers. Which one are you going to be over the next decade? Are you going to be on top of that K, where you're an asset haver and you're going to take advantage of all of that economic aspects? Or are you going to be an asset chaser and try to time the market and wake up one day and go, oh my gosh, what did I do? I built no generational wealth. I have nothing to show for myself because I let fear take over.
Yeah, it was all in the pursuit of perfection, which is 1,000% not attainable. So you just got to get that out of your head and keep moving. And this matters even more in unstable environments because cash flow tied to shelter demand behaves differently than speculative assets. People always need housing. And that means ownership is not just about today's payment. It's about future positioning. The families that own assets during unstable periods are usually the families with the most options later.
Stocks are always right eventually. Winter is coming.
All right, now on to our ever popular The Mortgage 101 Market Dashboard. Anthony, where are we sitting today?
Okay, Manley, as of today, the 30-year fixed mortgage is sitting approximately at 6.65%. The 10-year treasury yield is sitting around 4.48%. Now, mortgage markets right now are trading almost like a stress response. Every inflation headline, every tariff headline, every geopolitical escalation is instantly repricing risk. That is why rates can improve one week and then spike the next. This is not a stable rate environment by any means. The bond market is still trying to figure out where inflation ultimately settles during the long term. So if you're floating a rate right now, understand you are floating volatility.
Yeah, you're basically sitting at the top of the volcano that's just erupting, trying to ride an inner tube down that's going to melt along the way. So remember this, a rate can eventually be refinanced, but the years of equity lost from waiting, those years, they don't come back. If the payment works, the strategy works.
Don't let me leave, Murph. Don't let me leave, Murph. No!
All right, here's what all of this really means. America is entering a period of enormous economic transition. Tariffs, inflation, global instability, currency competition, supply shortages, and environments like this, ownership changes meaning. A home stops being just a purchase. It becomes protection, a fixed cost asset in an inflationary world, a hedge against rising shelter costs, a real asset in an increasingly digital and volatile financial system, and potentially a future income producing vehicle. History has never been especially kind to families who waited for perfect conditions, but has been incredibly generous to families who owned real estate assets during uncertain times. Because when the foundation underneath the economy starts cracking, the people who already own the ground beneath their feet are usually the ones still standing when the dust settles.
We're Anthony Manley. This is the Mortgage 101 podcast. You do not need to be wealthy to buy a home, but you may need to own assets to avoid becoming permanently priced out of the future economy. So if this episode made you think differently, share it with someone still waiting for the perfect time, because perfect timing rarely creates wealth, but positioning, it absolutely does.
Thanks for joining us, everybody. Like, subscribe, leave us a comment, and we'll see you next week.
Girl from the heart of Wisconsin to the waves of Hawaii, Manley and Anthony keep it real, not salesy. Breaking down rates and the truth you need to know, with a little soul and a little homegrown flow. It's the Mortgage 101 podcast where real talk meets home at last. Manly's got that Midwest soul. Anthony brings that island roll when the market swings and you don't know